Welcome to the Cash Flow Company. Today we're going to go over fix and flip loans. What do they look like? How do you get your best one? How much do you know you have to bring into each deal so you're not surprised at the end? Let's start with the basics of fix and flip loans. It all starts with ARV. What is ARV? It's called after repair value. In simple terms, it's what it's going to either appraise for or what you think you could sell it for once you're all done with the rehab. All fix and flip lenders have an ARV they'll lend to, the maximum loan they'll lend at any property. Typically in this market it's 70%, but some are back up to 75%. Remember, that's the estimated value you're going to either sell it for or get it appraised for. For example, you're going to sell a property for $200,000 and they'll lend up to 70%. They'll lend you up to $140,000. That works if it's a $500,000 property. They'll lend you 70% or $350,000. So that's the max amount they will lend you on that particular property. Now that doesn't mean that that's the amount they're going to lend you, because they have other requirements that go below that, or you have to actually calculate before you know the actual number. Typically in this market, if you're a seasoned investor, they'll lend you 85% of the purchase and 100% of the rehab. Any project you do, you're going to have to bring in 15% of the down payment. They'll cover all the rehab. So let's just look at a quick example. If you have a $200,000 property that you're going to sell, the ARV that they'll lend off is 70%. That's $140,000. But they're only going to give you 85% of the purchase, 100% of the rehab. That is your typical fix and flip loan in this market. If that property is going to be purchased for $120,000, they're going to lend you 85% or $102,000. You're going to have to bring in the other $18,000. The good news is the rehab, and let's just say the rehab on this property is $20,000. They're going to give you all the rehab costs once the work is done. They can lend up to 70% of the ARV, but as you see here, they're going to lend 102 of the purchase, 20,000 of the rehab, so they're going to give you 122,000. In a fix and flip loan with one of these products, you're going to have to come up with the $18,000 for the down payment. Next comes the other costs, the other amounts of money you need or need to have in what they call reserve. So first of all, let's go through reserves. Most lenders are going to require 6 months of interest payments in an account. They just want to make sure if anything comes up, you can make those payments. So that's another thing you're going to have to add to what you need for a fix and flip. Next, you're going to have to bring in the closing costs. You're going to purchase that property as going through a closing agent. You're going to have to pay those costs for that closing agent plus any lending closing costs. Next, you're going to have to pay the interest payments on a monthly basis. So you're going to have all of these items either in an account or accessible to make sure the flip is successful. There could be other items too that you need, but these are just the basics when you're looking at a fix and flip loan. Even though they say they're going to lend to 70%, remember there's other criteria in there to figure out exactly how much you need for each flip. So first thing when you're looking for a fix and flip lender is you want to find someone who's going to give you the most on your purchase. Instead of 85, maybe it's 90. And also a lender that maybe will go from 70 to 75% ARV. All of those things will mean less money out of your pocket and more leverage on the deal. There's a lot of free tools on the Cash Flow Company that will help you become more successful in real estate investing. Go check them out. It's thecashflowcompany.com. And if you have a question or you have a deal you want us to look at, just email us. Our email's below. Now let's keep the money train rolling. We'll catch you on the next video.